Welcome to the video on how to use the Position Size Calculator. Here we are in the Stock Think Tank member portal. And in the left-hand margin, you can see all the resources and tools that we give you guys. But the most important one by far is this Position Size Calculator. It's the most important one by far. And the reason is it does two things for you. It manages your risk virtually automatically, and it helps to build habits that teach you to manage money like a professional hedge fund manager, like a professional active investor. And it takes care of your risk for you. It keeps that risk in line. There is nothing we or anyone else can do to eliminate risk in the stock market. This tool helps you keep that risk in line and helps you manage it. So the first thing I want to do is explain to you why we use this tool. And then the second thing I'll do is show you how to use it. I'm going to take a look at the core portfolio where it sits at this particular snapshot in time. And here you can see that in the core portfolio, we have 4 stocks, and in the special plays portfolio, we have 2. Both of these happen to be ETFs that don't qualify for the core portfolio. So it's a good mix right now. We also happen to have 3 stocks profitable and 3 stocks in the red. Now, if you look at the position size column here, you'll see that we have a varied amount of shares of these 6 securities. 139 shares of Lowe's, all the way down to 4,617 shares of UUP, which is Invesco's US Dollar Index ETF. Why do we have such a varied number of shares? Well, that's the whole point of the position size calculator. It's because it keeps your risk in balance. Notice here that the portfolio size in this model portfolio that we track is right around $80,812 right now. Our risk per trade is 2% of that amount, which amounts to $1,616.24. Now, most people, when they buy securities, when you send them a signal or give them a tip to buy a particular security, they say, well, I'm going to buy 100 shares because I always buy 100 shares, or I'm going to buy 200, or I'm going to buy 500, or I'm going to buy 50. Or they say, I'm going to put $5,000 into this, or I'm going to put $2,000 into this. And the amount of shares is just the amount they can buy with the money they're willing to put in it. Here's the reason why that doesn't make any sense. If you're putting $5,000 into something or $2,000 into something, you're not cognizant of the amount of risk that you're willing to take. You have no concept of where you're going to get out of that trade. But because at the Stock Think Tank, we not only give you the entry price, we give you the stop price that we're looking at. So now you know exactly what your risk is. For example, in Lowe's here, the entry price is $157.50. The initial stop was $146.45. Your risk is $11.05 per share. If you take $1,616.24 and you divide it by $11.05, you get $139. That's where we get the amount of shares, so that we keep our risk the same. You'll be able to calculate yourself, if you'd like, that every single one of these is the same. AbbVie, it's $8.05. We enter at $105. Our initial stop is $96.95. That's $8.05 difference. That means that $1,616.24 divided by $8.05 is 200 shares. Now, for most people, because Walmart is priced at about $145, okay, we ended up entering it at $146.60. And Foot Locker, we ended up buying at $40.37. Most people would have many more shares of Foot Locker than they would of Walmart because Foot Locker's cheaper. We're the opposite. We have more shares of Walmart than of Foot Locker. Why? Because the actual risk we're taking in Foot Locker is about $6.05. That's our entry price versus our stop price. If you take our entry price, you subtract our stop price, $6.05. But in Walmart, we're taking $4.65 of risk. We entered Walmart at $146.60, and our initial stop is $141.95. That's $4.65. So we've actually got more risk in Foot Locker, $6.05 a share, than we do in Walmart, $4.65 a share. So we want to balance that all out. So if we go across here to the actual initial risk of each one of these trades, look at these dollar amounts. $1,613.30. 16, 16, 16. 1610, 1613.55, 1614.25, 1616.16. All of these are virtually identical. They're right in that same area of $1,616.24 or less. That's balanced risk. That means if any one of these trades loses, it's not going to destroy our entire portfolio. And if you think that that can't happen, well, Mike created this table. And these are real symbols, real stocks, okay, they're real securities, and those are real entry prices. This is a fictional portfolio of 10 stocks where this particular active investor had 90% winners. If you look at the gain-loss column here, up 15%, up 16, up 18, up 15, all the way down to up 50% and up 19% on stocks 8 and 9. But stock 10 lost 8%. If I told you this trader had 90% winners and I showed you just this gain and loss column, I bet you would bet me all the money in the world that this particular trader made money. But he didn't. He or she lost $2,500. Why? Because they bought 100 shares of each. And those 100 shares amounted to these particular gains and then this one big loss. Because this particular active investor, he or she did not manage risk based on the stop or where they were going to get out and manage the position size based on the amount of actual risk they had in the market. In this particular case, it was around $100. This particular active investor lost so much on one stock that the entire portfolio got wiped out. If you've ever traded before, you've probably experienced that, where one trade ruined your whole performance. That's because your risk was not balanced. This particular method also helps you not fall in love with any one particular trade that you have, because the risk is all the same. The reward will be similar. Some will make more than others, but the risk being the same is critical to managing your portfolio like a professional. So now let's go back to the member portal and let's take a look at the actual position size calculator. So here's what it looks like. Click on this tab and it looks like this. Now, we expect that everyone who joins the Stock Think Tank wants to be treated like an adult. So we're going to treat you like adults and say there's 2 decisions you have to make before you start following our alerts. Number 1 is how much money are you allocating to this program? What is your portfolio size? That you can see right here. Let's use the example of where we started the model portfolio, which is $50,000. So you would put that portfolio size into this tab. Now, the second thing we expect you to decide on your own is what is your risk per trade. Now, this risk should be small enough that if we fill the entire portfolio, you'll be able to take all the trades. But it should also be large enough so that it makes an impact on your portfolio and allows you to enter retirement whenever that is and live a life that you choose. So let's go with, again, the percentage that we used in our core portfolio. This is not a recommended percentage. This is just what we used. If you have $1 million in free retirement capital and you're putting $50,000 to this portfolio and you want to go 20% per trade, that's fine with us. We don't care. These 2 are your decision. Now, once you enter this risk per trade percentage, which I'm going to put back at 2%, that should never change. What will change is the portfolio size. As you make money and as you lose money, you're going to change this portfolio size. And you're only going to change it with closed trades, not with trades that are open. Okay, just with closed trades. You're going to change that portfolio size figure. But for now, with the launch of your particular portfolio, we're going to go with $50,000 and 2% risk per trade. Again, it can be whatever you choose it to be. 2% of $50,000 is $1,000. So on your very first trade, that's going to be your risk. So let's put in some actual trades and see what this tells us to do. Let's take the Walmart example. When we sent the Walmart alert out, the alert was to buy Walmart at $146.75 or better but not below the initial stop price of 141.95. Now notice what I did here. I put the entry price from the alert in entry price, and I put our initial stop in stop price. That gives you the position size you're going to enter into your platform. So when you go to your stock trading platform the next day, either the morning before the open or when we send the alert in the afternoon, if you want to put it in at night, make sure that your platform is set to put that trade into the live market when it opens. You're going to use 208 as the amount of shares you're going to buy. So you're going to place a buy order to buy WMT 146.75, 208 shares. Now you may get a better price than that. You may get that price. If you get a better price and you then want to adjust after the fact, you can do that. But to start, this is what you're going to do. Now notice what it does here. 208 shares means your actual risk per trade based on position size is $998.40, which is within your allotted $1,000 risk per trade. That's how this works. Let's use another example. Let's use Foot Locker. In Foot Locker, the alert was 40.50. Okay, buy Foot Locker at 40.50 or better, but not below our initial stop price of 34.45. That's going to give you 165 shares of Foot Locker. So that's what you're going to do. You're going to go to your platform before the market open and place a buy order for Foot Locker at 40.50 for 165 shares. Notice the risk per trade, $998.25. which is within your $1,000. Now you can see there's another spot down here. You can put that in or you don't have to put that in. That's for the target. And that gives you the automatically calculated reward to risk ratio. So for Foot Locker, our target was 46.95. That gives you a reward to risk of 107 to 1. What does that mean? For every dollar you're risking, we expect to make $1.07. This will almost never be below 1. Okay, sometimes it will be well above 1. It really depends on how the trade sets up. Let's look at AbbVie. AbbVie was an entry price of 105. And our stop, our initial stop, which was in the alert, was 96.95. 124 shares, which gets you to 998.20. The target on AbbVie is 115.95, 1.36 to 1. So for every $1 you risk, we expect to make 136. Let's look at Lowe's. Lowe's, the entry price was 157.50. That was in the alert. The stop was 146.45. That's 94 shares of Lowe's. The target on Lowe's is 171. That's 133 to 1. So that's how you use this tool. Now there are other little tweaks. For example, if the position size ever comes up as 0, check your work. But it also could mean that the risk was too excessive in this particular trade. For example, let's say that you only had a $5,000 portfolio. Okay, that already takes you down to 9 shares with 2% risk per trade. Let's say that we decided that our stop was going to be at 50.45. We want to risk $107 on this particular trade. Notice that position size goes down to 0. That just means you don't take the trade. That's all that it means. Okay, by the way, if we ever did that, this would be somewhere around 300 probably, and the risk reward would be correct. But if we ever did do that, let's say that we wanted to risk $150 for a particular trade, it was just that kind of a setup, and your position size came out as 0, that just means you skipped the trade. That's all it means. So there's little nuances here and there, but for the most part, 99% of the time, you use this position size calculator and your trades will be sized correctly, and you'll be following the program as it was designed and as it was built. That's it. I hope this video was helpful, and reach out if you have any questions. I will talk to you guys in the next video.